So financial statement analysis. So we're going to spend about 15 minutes there or thereabouts on this. Well, so we go. So this is obviously an actual exam question from a couple of sessions ago. And so what we've got here, I'm not saying you're going to have two companies. You might only have one company. You might be for more years. It might be one company against the industry. To be honest, I actually haven't looked at the final exam paper for a little bit, so I'm not lying to you when I say I actually don't know right at this point. But what we have here is a company or two companies across 2 years. We've got certain information, and so it's selected financial information. We've got some information from the income statement or the profit and loss statement. We've got some information from the balance sheet. We've got some, wrong mouse. We've got some share price information, end of year share price, number of shares outstanding, and then we have calculated the ratios. So that's really important, and you know, I've stressed this in the content. You won't have to calculate anything for this question. Like, if you want to, you certainly can, but you don't need to. So the things that I would do with this, so move everything back a little bit, give myself some room. The things that I would do with this is a first pass, just eyeball. So I've got multiple computers here and keep using the wrong mouse. I would just eyeball this information and just see if there's anything, you know, if there's any big changes, if there's anything drastically different, you know, if anything sort of pops out as the difference between the two. So this company, if we look at sales to begin with, I'll zoom in a little bit. You know, it's gone up marginally, gone up, but I mean, it's gone up to sales, so that makes sense. Interest is basically negligible, so that's not much we have to worry about. Net profit, there is a net profit, and obviously, you know, they've had some tax taken out. So profit, even though sales have gone up, net profit before tax has come down slightly. Net profit after tax. On this side, things have gone up, about the stayed pretty stable, again, negligible. Profit's gone up substantially, profit's gone up. So, you know, this, whatever it is a much more profitable, you know, and even before we get to the ratios, you can see it's a much more profitable company. You can see the direction it's going. Granted, we're looking at just 2 points in time, but the direction it's going is much more favorable than what's happening on this side. In terms of balance sheet information, seems to be much more a cash business. So collections, even if we have account receivable turnover information, collections don't really seem to be an issue with this company. Yes, it's doubled, but I mean, as a portion of sales, it's negligible. From this company, substantially more accounts receivable, but that balance is going the right way. So they're looking like they're improving their collections policy. Inventory, you know, they hold a reasonable amount. They sell a bit more. So you can work out the turnover on that, but no major changes. Current assets, they've got way more. These guys seem to have, well, proportionally might not be much more. They've dropped the amount of current assets, stayed pretty stable. Total assets have stayed pretty stable. So there's not, doesn't look like there's much of a change in composition of the assets of this business. This business, in terms of assets, has got a little bit smaller. Again, we don't have much information as to why, which is actually, as you get to later on in the question, you know, you can speak to. You can say, well, we don't, there's a lot of stuff we don't know, and we don't. Current liabilities have gone up slightly. Current liabilities have gone down substantially. Total liabilities have dropped. Total liabilities have dropped. Equity gone up. It's gone up. So, I mean, the first pass, I would spend, you know, if you get in, remember, you're going to have, for this sort of question, you're going to have, what's that, 24 minutes? Something like that, 24 minutes. I'd spend the first couple of minutes just going through and just trying to get a little bit of a mental picture of what's going on. They're both selling a fair bit. This company is far more profitable. They seem to be more of a receivables, you know, a credit type business, but they're improving their collections. this business as a return on equity, well, a lot smaller in terms of assets. The sales are about the same, yet this company is way more profitable. And it's not purely driven by cost of goods. The cost of goods sold, they're not that different. So this company has a lot more of other expenses. Now, we don't know what those are, but something else is happening behind there. End of year share price has dropped. If we start looking at the margins, discuss and compare the profitability of each company, well, if we start to look at these things, most of this we've already got a sense of by looking at what's happened above. We know, they're both, the margin, this company has much better margin. Profit margin is much better on this company. Return on equity is much better on this company. Return on assets is pretty small, better on this side. Current ratio, that's potentially a bit of a concern, all things being equal. You'd like, anything under 1 is arguably a bit of an issue. I know if we look at, say, Woolworths regularly have a current ratio under 1, but they're big, long-term profitable business. But anything under 1 means they don't have as many current assets as they do current liabilities, and so there's a bit of a cause for concern there. As we talked about, these numbers, this company, this is almost irrelevant to this company because it basically doesn't seem to use receivables. It's mainly a cash business. They turn over their inventory about the same. There's not much of a change here. So they're selling through their inventory about 4 times a year. Less risky. There's less debt sitting on this side. Times interest earned. Well, they make substantial profits on both of them and they can cover their interest really well. These guys especially. But this is still really solid. EPS itself doesn't tell you anything. EPS is primarily used for the price to earnings ratio. The Australian averages roll between 12 and 16, so both have dropped. Both from 11 down to 9, from 14 down to 9. So it seems this one was much less loved initially, and it's certainly becoming much less loved now. This company, interestingly, has gone from something which was sort of at that upper end of average down to the market, and that's really an important point. The market doesn't seem to be too particularly like it, which, given that its profit is going up substantially, is a bit weird. Is what it is. So based on the above information, discuss and compare the profitability of each company. So I'll use that as a starting point. Is the way I break it down is if you ask to discuss and then compare between sort of 2 companies, it's just roll through that. Just, this is a gross margin, provide, it's a pretty reasonable, pretty not, sort of roll through this is what their margins are, their profit margins, their returns, and then compare it between the 2, and this company looks far stronger on a profitability side of things. One thing that could be potentially useful is, and for those in my classes, my favorite 2 words are it depends, and it depends on what the industry is. But look, if you have a spare moment, which is a big if, maybe worthwhile going and having a quick look at, can you find, market averages or industry averages, or just general kind of, large corporate averages for, what a decent ROE is, what a decent ROA is, what profit margins, just something can kind of show that you've done a little bit of additional work. Because again, think about how that signals to us that if we've seen that, you've written in that, a gross margin of 60% is it good or is it bad? I mean, it does depend a lot, but if you can kind of give us that this relates to something else, it sort of shows that you've done some additional sort of prep work, and that can never that can never hurt. Obviously, there is a cost-benefit decision you've got to make with how much sort of investment you want to spend in time to look at some of these things, but it could well be worth it. So obviously with things like gross profit, ROE, ROA, a bigger number is better. But how big, and is it good for the market? Is it good for the time? Those are difficult things to answer. Current ratio under 1 is a bit problematic. Generally the rule of thumb is 2 or more is decent. But again, you see businesses like Woolworths have current ratios less than 1. When it comes to liquidity, you're looking at how much they're able to sort of generate cash quickly. Receivables in this company don't seem to be an issue because they're mainly a cash business. The current ratio is lower, so that's a cause for concern, but they seem to be able to generate cash relatively quickly, and they're turning their inventory over about every, 3 months. Same as this company. These guys use receivables more. They don't seem to collect as frequently. So even though they've got a better current ratio, the fact that these numbers are where they are says they're not collecting as quickly as the other company. And so that's a bit of a problem. It's gotten better, but it's a bit of a problem. Solvency of each company, debt to assets. Look, and this is one of those ones, you want some debt. If you don't have any debt, then you're potentially giving up the opportunity, sort of lucrative opportunities if they're there. And you hear it at the moment. Interest rates, the Reserve Bank has just cut, and obviously that's their rate, 1.5%, but the banks are generally coming down. So the cost of debt is reducing. That means that the cost of borrowing is less, which means, opportunities which exist in so much as they do, you can take advantage of them. The flip of that is you don't want too high and what is too high, but, if you have like a 95% debt to assets, that's really risky. And if things go against you, you can be out of business very, very quickly. In both of these cases, they're certainly well within that. They have both reduced their debt to assets ratio, so they've both got a little bit less risky. This company here has a lower rate than over here, so they're sort of less risky than this one, but it's pretty marginal. These guys are much more able to service their debt. Like, they can just pay that debt really quickly, and we can see that up here. Like, they're making large profits before tax and very little interest. So there is no problem. There is no problem with either of them really with liquidity. With solvency. If you were required, so that's kind of covering off the first bit. So it's just working your way through. Try to understand. Look at it. Look for sort of differences between them. Look at just any numbers or any sort of trends which kind of pop out as something of interest. And then just write about it, sort of see, because you're using that to try to understand what the company is doing. Now, if you were required to make a recommendation to a client to invest in one of these companies, what other information would be helpful in making that recommendation? Now, this is a really good point of where reading the question is really, really important. We weren't asking, make a recommendation. What we were asking for is actually what other information would be useful. And the other information which would be useful would be, we know they're two large Australian retailers. We would want more data than 2015, than 2016-17. We'd like to know what sort of actual businesses they're in, what they sell, what's going on in the competitive environment. Are there competitors coming in this particular sort of segment of the industry? What's the economic conditions at the time? That would be relevant. What's their general strategy? Are there other, certainly time series data would be useful, who they are, strategy. Are there information in sort of news, like in, press releases, company releases, do analysts have information on them? So there's actually quite a wide variety of information about a company that you'd want other than in the financial statements. So that's what we're trying to pick up there. So what other things would you want to know? And just kind of go through that list, because very few people will trade just based on and make these decisions. They'll use this information, but they'll use that information in conjunction with other things. So it could be the management disclosure and analysis in the financial statements, for example. Those are all relevant things. So do you need to run through all the property? Yeah, look, you don't need to necessarily pick each and every one. Like we're not marking a checklist like, did you talk about, there were 4 ratios, did you talk about all 4 of them? Kind of like the account numbers, we're trying to get a sense, and you're trying to get a sense of what the company is about and what's going on. So short answer, no, you don't. We still want to see, within the constraints of how much time you've got available, there's something which kind of goes, roughly what's going on, more so than just this one went up, this one went down. Like it's got to be something slightly different than just that. Do you need to compare different year in the same company? Look, I think it is useful to, that sort of as a follow-up, it is useful to do that. And it doesn't have to necessarily be with each single one. Look, because we understand that you've got limited time to do this. So if there's something which is really standout, as you see, I did there, like a number of things didn't change too much. So I didn't need to say much about them. Just go like, these ones didn't really move too much, but this is something which sort of sticks out. Cool. So those are those ones. Like interestingly enough, I hope I haven't done it for you guys for this one. There's actually, this company is a bigger company and it's slightly more profitable, but it hasn't many content flags in either business. So I mean, there's nothing super interesting, like amazingly interesting about it, but it means you've got to kind of work your way through. But just have a look to see when you're going through it, does anything stick out? And talk about that. Look, that's all you can really sort of ask for in this. So go through, anything sticks out, and then kind of work your way through, some key points around, what's changed or just what's changed within, and then how these two things compare across. Cool. All right. That is financial statement analysis. We're going to move to high-low. Will we? Yes. Next question. So question 3, high-low. There are a number of... So firstly, the question about high-low, or this particular topic, is we're not worrying about absorption costing or anything like that. So the high-low method is the sort of practical component of what we're going to have to be doing here, and this is an example of it. What would be, using the high-low method, what is JT Media's printing cost equation? So, because I obviously can't show you what's... So can you guys all see the Excel sheet that I've got? Yeah, Yep. Cool. All right. So what I've done, and obviously how I'm about to do this, you can't do in an exam, but the general point will still hold. With a high-low analysis, you're trying to match up horrible. Yeah. I'll move this, and then I'll change this. I'll change that. Do it to make these a bit bigger. Okay. So we can see what we're talking about. All right. So the point of high-low analysis, well, the point of this analysis is, again, to take a step back, and it will be relevant for some of the theoretical components, is what are fixed costs, what are variable costs. So we've got cost along the vertical, we've got output along the horizontal. We can see there's a relationship. It's not great, like it's a bit scattered, but we're trying to get a line of best fit. I'll just add that in for the sake of, oops, a trend line, just so we can see it. Okay, so this is the trend line. So that is actually the regression line of best fit. But to do that, if you've got a computer in front of you, it takes about 2 seconds, as you just saw. Obviously, you can't do that Monday. So what we're trying to do is to get the widest points. So we want to take this point here and this point here and draw a line to meet them. And we want to get the gradient of that line, and we want to get where that line meets the intercept. So when we're doing high-low, we want high volume and low volume. We don't want to have anything to do with high cost and low cost. That's the kicker point. High volume, low volume. Whether or not it's high cost or low cost, we don't care. It's high volume, low volume, and then make these 2 points meet. So that's the idea of what we're doing. So with this, because I can, this is the maximum. So it's 32,649, and the cost associated with that maximum, that's what we're using. Then if we've got the minimum, 25,351, which is down here. So 25,315, so not, yeah, 315, and 5,444. We don't care about this number. I think it's the lowest. We don't care about 7.6. We want the highest and lowest output, and then the cost associated with that output. Oops. And then cost, just because I'm being lazy. Okay. So the output is this much, and what we want is really the differential. So the difference in the output is 7,334, and the difference in cost is $925. If we look on the chart, the difference between here and here is the 7,000 units, and the difference in cost is just the difference between this one and that. And so the total difference, all right. So what we end up with is 13 cents. So for every marginal unit produced above 25,000 units, it costs an additional 13 cents. Now, if you notice really quickly, and you've probably done this yourself, that's not exactly 13 cents. And this is where a rounding sort of difference is going to crop up. For the purposes of this right now, I'm going to use the exact number. So I'm not going to round it off to 13 cents. Sorry, yeah, round it off to 13 cents. So what we then do is we feature back into this y equals a plus bx. We know what y is, y being total cost, and I select one of these costs because that's y. And so I'll use top one. 6,369 equals a plus 13 times, and because we're using the top one, we use this output, 32,649. I'll gap that out a bit so you can see it a bit. So 6369 equals A plus 13 cents times 32649. Rearrange it. A equals 0.13 times 32649 minus 6369. And I'll actually calculate it now. That minus, sorry, I should have done it this way, 6369. Probably watching that going, why is he doing it that way around? Equals G2 minus, so equals $2,251. I would just round it off to dollars at that point, so 2,251. So what that means is you have a fixed cost, I'll just write it up here. So your fixed equals 2,251 and your variable equals 13 cents a unit. If you'd done it slightly differently, and I'll just write it in below, if you'd used 13 cents rounded off, you would have 6369 minus times 32649. You end up with something which is about $120 different. Look, and that's reasonably material. However, we know that there's going to be alternate ways of doing this. So if you got 2,124, that is not wrong. So just be aware of that as you're going through it, that if you've rounded off, I think a lot of what we calculate and a lot of the answers that we put forward have included all the decimal places, even though we've not physically shown them. But it doesn't mean that you're wrong. And you would get full marks for that if you'd done that. So that is not that question, not that one. There we go. Using the high-low method, what is printing cost equation, which we just did? What would be the expected printing costs of producing 31,000 units? That's relatively straightforward. You've got this. It would just be Y equals 2251 plus X 0.13 X. And so if you're looking at 31,000 units, you just put in X, replace that with 31,000 and solve. So that's relatively straightforward. Be aware also that there's not just going to be calculation questions. There could be questions like this, is, you know, you're told what the relevant range is. So you're going to have an understanding of what relevant range is. You're going to have an understanding of what fixed costs actually are, what variable costs actually are, what mixed costs actually are, you know, and what they change over. You know, so it's good to have an awareness of that. No worries. Thanks, Jemima. 2251. 2251.1, 2251.14. Yes. I mean, we're not going to quibble about 1 cent. I can tell you that much. So that be CVP. Sorry, no, not CVP. We've got to get there yet. So that's be high-low. Any questions on high-low at this point? All right. Cool. How do we answer the relevant range question? Right, where is it? If you're told the relevant range for JT Media Limited is 24,000 to 36,000 units, what does this mean and why is it important? All right, so I will frame that in why, well, how would you answer it? Well, you need to discuss what relevant range is, and the relevant range relates to where that linear relationship holds. So for example, if you know the cost equation, the fixed cost is 2251, that relates to that range of 24 to 36. Why is that important? So imagine if you were considering an expansion and you were going to produce 50,000 units or 80,000 units, or I don't know, much larger numbers. It would be unwise to continue to use 2,251 as the fixed cost for whatever your kind of underlying analysis is, because it just wouldn't be relevant. Like if you're expanding out that much, you're likely to have increased fixed costs. You're likely to need more production equipment. You might have a bigger space. There might be other things that have gone up. So if you're then basing your cost structure on an incorrect fixed cost, then your forecasts are going to be out and your pricing is going to be out, and you may well end up losing a lot of money. So understanding that the cost equation we just worked out is predicated on a range of 24 to 36 means any output, expected output outside of that range, that cost equation won't hold, and you're going to make some really bad decisions, or you potentially could make some bad decisions. So that's why it's important, and that's how you sort of go about answering it. Did that make sense? Cool. Well, hopefully that made sense. Next bit, last bit, CVP. Yes, now it's CVP. Jumping ahead. Sorry, just hang on. I just want to see who's on here at the moment. Yeah. Jono's reading this, so I bet he's concerned I'm getting some of these wrong. Ash's awesome as Musings Proprietary Limited. Okay, so we've got a company that sells fidget spinners, and if you remember fidget spinners, these were actually quite a big deal back a couple of years ago, and if you weren't part of that craze, you just realize how quickly the world moves, because it was only 2 years ago. Okay, so the critical thing is we have a company producing two types of things, not two types of things, two products. Each of those products has a price. Each of those products has a variable cost. We also have information on fixed costs. So fixed costs, we have sales with a product mix because we need to work something else out, and we have the corporate tax rate. So we've actually got a whole range of information. This is actually pretty much the whole gamut of what you'll need to be able to do for a CVP question. I don't think we can make it that much more difficult. So what do we do? Copy this bit. Do I have it printed somewhere else? No, I don't. All right. So before we get into this, profit equals revenue minus costs. Really important setup. And I'm assuming you can all still see my screen. Yep, awesome. Okay, so profit equals revenue minus costs. Profit equals revenue minus variable costs minus fixed costs. Profit, or even profit, I should say, minus is price times quantity minus variable costs per unit times quantity minus fixed costs. All right. So we have 5 pieces of information we need: profit, price, quantity, variable cost per unit, fixed cost per unit. Have those 5 things, or have 4 of those 5 things, work out the 5th. Problem we have is we have 2 prices and 2 variable costs per unit. So to do this sort of question where you've got multiples, you've got to create a weighted average contribution margin. And the way we do that is the following. I'll just color this out so you can see that's the information provided. Calculate the contribution margin per unit. Price minus variable costs. Price minus variable costs. But we still have 2 contribution margins, so that doesn't particularly work. Sales mix. And the sales mix is 80% of the standard model, 20% of the premium model. Now again, this may not actually work out to be that, but we can only go off what we know at this point. So 80% of your sales are standard, 20% are premium. Multiply those 2 together. I don't know why that's a different font or different size. All right, so we end up with a weighted average sales mix. Now, we still have 2 of them, but what we want to do, that should be %, is to add these 2 together. And this is the holy grail of what we're after, the $7.70. So what that means is, irrespective of exactly which unit you've sold, when you sell something based on an 80-20 sales mix, when you sell stuff out, you're going to make an average, weighted average sales, weighted average, what am I doing? Contribution margin. When you're going to make a weighted average contribution margin of $7.70. So $7.70 of a random unit that you sell, assuming that sales mix, you're going to make $7.70 to pay off your fixed costs, and then from there, it will become profit. Now that $7.70 is the one number we now need. So if you're doing it with multiple units, that's the number that we need to hold down to. And we don't add it in directly into this, but we know that price minus variable cost is contribution margin, and what we have here is price minus variable cost. So we can actually simplify this. Variable costs per unit times quantity minus fixed cost, because profit is contribution margin per unit times quantity minus fixed cost. And this is what we use it in. So we know this $7.70 is our weighted average contribution margin, and it gets put in here. That's where this comes in. Now, let's have a look back at the question information to see what else we need. The break-even point. Break-even point is when profit is 0. So profit is 0. We just start replacing the variables. 0 profit equals $7.70 times quantity is the unknown minus fixed costs, and fixed cost $20,000 monthly fixed cost. Where are we? Minus. So quantity equals 20,000 divided by 770. Equals, if we want to, round up. So what we end up with is 2,500. I hope that's the answer. That's the answer I've worked out. We end up with $2,598. Can't see that. 2,598 units all up. That's not standard or premium. That's just combined. You're going to sell 2,598 units to break even. coming back to the question. So that is, for all those in my class who are kept getting lazy with it and just working out one not the other, that is the break-even point in units. Now, that's all units, and we haven't done sales dollars. To get sales dollars, you would then need to split that out, and we're going to do this. You would then split that out to figure out how many of each model you make, and then you need to, the easiest is then to multiply it by the price. So to do that, let's give ourselves some space here. So equals, this is where it gets a little bit fiddly, but that's all right. So that doesn't quite work. So we'll round that. We'll round that. Round that. Okay, so that's the number of units equals $10 times that many units equals $15 times that many units. Okay, so that's the first bit of that question all done. 2,598 units, 2,078 standard, 520 premium, whatever they're called. Yep. Multiply the number of units by the price, and that gives you a break-even revenue of 28,580. That's sort of stepping through each of the bits. Just mindful of time. All right. Monthly before tax profit, and then I won't do part 3 because that's a little bit involved in just giving the timing. But what I'll do is I'll do part B, and then I'll just flip part B a little bit to do something else, just to see the tax component. All right. So if we come back to this, we'll get rid of all that stuff. I'll get rid of all this stuff. Oh, actually, I want to get rid of all of it. Now, imagine for part B, we're wanting to know a pre-tax profit. So for pre-tax profit, that's really easy because this number here is pre-tax profit. So if we want to find the pre-tax profit, we literally just swap out break-even of 0, throw in 40,000, and then just move it all around a little bit, equals quantity equals equals 60,000 divided by 7.7, round up. So you'd have, I don't know if it was in a units or not units question, but you'd end up with 7793 units. So all you have to do to find a profit instead of break even is just to swap out profit and put in, or swap out 0 and put in whatever the profit happens to be. So that's when you're dealing with pre-tax profit. With post-tax profit, it's not as straightforward because there's no way for tax to kind of feature within this nice and cleanly. So if you're working out a post-tax profit, you've got to take that post-tax profit or that after-tax profit and work out what the equivalent pre-tax profit would have been, and then use that and build it in. So the example that we have here is, let's imagine there's multiple things changing in this one, so I'm not going to do it because it will just take a little bit long for now. Let's imagine they wanted, this was pre-tax, sorry, this was after tax of 40,000. And the tax rate is 27.5%. So we'll just come down here, profit after tax, I always get this wrong. Profit before tax. No, we want profit before tax. Profit before tax equals profit after tax divided by 1 minus the tax rate. Now, as I said, I always generally get this wrong. My classes, you'll know that like there's a way to double check it. But if we want profit before tax, because that is the number that this profit before tax is what is this. And if we want a $40,000 a year after tax profit, divided by 1 minus 27.5%. Profit before tax equals 40,000 divided by 72.5%. Profit before tax equals 40,000 divided by 72.5%. Equals, that's annoying. Anyway, equals 55,172. So the equivalent of an after-tax profit of $40,000 at a tax rate of 27.5% is the equivalent of a before-tax profit of 55,172. And that passes the smell test because it should be bigger. Because remember, the government is taking money out of this before it becomes your after-tax profit. So they're going to take a cut of 27.5% of this number, which will then leave you with 40,000. So that's a really good double check, and that's a general kind of thing you should be doing with everything, not just in this subject, generally. Does it pass the smell test? Have you worked something out? Have you calculated something and you look at it and you just go, oh, hang on, this doesn't make any sense whatsoever. If you've got to that point and it literally just doesn't seem to work, it may be as simple as you've left a decimal place in or you just punched something wrong into the calculator. So just take a step back. So always just take a step, have a look at it. Does it seem to be reasonable? And if it does, all good. If it doesn't, have a quick look over your working and see if you've just made a silly mistake along the way. But if you've got that number, then all you do is you just replace it in 55,172. 55,172. That leaves you to, what is it? 75,172 equals 75,172 divided by 770. Round it up. That's now 9,763 units, which again makes sense because you need a bigger profit to get a 40,000 after tax instead of before tax. And we've gone from 77,000 units to 97,000 units. So again, it kind of sort of makes sense on that front. But that is the nuts and bolts of most of CVP. So we've covered off, I mean, those are the three big areas that people had questions about: financial statement analysis, high-low, and CVP. Hopefully that was of use. Fingers crossed the recording worked, because if it, had a few technical difficulties today, but if it did work, I will definitely be putting this up on UTS Online, just if you need to sort of go over it again or if other people couldn't make it. The last is tomorrow. You'll probably get an email about it anyway, but tomorrow there are going to be two face-to-face revision sessions, one at 1 o'clock, one at 6 o'clock. Details are all up on UTS Online. If you have any other questions or you want anything else discussed or whatnot, feel free to drop in on any of those. Those will just be pretty laissez-faire, just based on what you guys, what questions come on the day. So that's also an option. But to wrap things up, okay, so I'm just going to quickly run through the questions that are coming through, and I won't bring names to people on this, especially those who are done privately. Yeah, so all the ratios, so for question 1, we will have calculated the ratios. You will not need to calculate anything for the ratios. That's a question. The the live sessions will be covering whatever. It won't necessarily be covering this stuff. It'll just be basically, I will be in a room for 2 hours, well actually 4 hours all up. I'll be in a room for 2 blocks of 2 hours, and I will just respond to questions as they come through. So if there are lots of people there, and I've been in sessions where there have been, standing room only, I've been in sessions where there have been me and, 10 other people. I have no idea what tomorrow's going to be. But yeah. The formula, all right, so I'll come back to that. So that's what tomorrow's sessions are going to be about. The exam time, the exam timetable is already up. The exam timetable got released some time ago. So you will need to check the links on that. So the exam timetable is already out there. I don't know if you meant something else. The formula, if you go to the UTS, if you go to the final exam revision folder on UTS Online, the formula sheet which is in there is the formula sheet from the exam. Anything else you need, you're going to have to remember it, but that's what's provided. There is no question on absorption. Cool. Variable costing, yeah, so absorption costing, variable costing, income statements, no. Great. Well, I think on that note, we might call it a day or a night even. I hope that was of some use. Apologies for the small technical glitches up front. My microphone, which normally is just a plug and play thing, decided to have a bit of a moment, and so I had to go with the phone audio. But hopefully that kind of worked out okay. If you have any other questions, there's a discussion board, there's tomorrow, there's UTS Online, so just there's emails if you really need it. So please feel free to get in touch. But otherwise, all the best with the studying, and yeah, have a great rest of the week.